This is August 3rd, 2026. This economic report is on today's leading economic indicators. At the top of that list, we'll start with the consumer confidence. Consumer confidence ticked down again in July. It's exactly at the same level as it was before the Great Recession of 2008, and that's not that good. But having just said that, the consumer is hanging in there with the consumer spending up over 6% in the trailing 12 months. So, thanks to the consumer spending, today the economy is hanging in there. But looking forward, this essay is on leading economic indicators. So let's look at leading economic indicators from the 30,000-foot level. Here are a dozen leading economic indicators that have historically been, really good at forecasting the state of the economy moving forward. We'll look at a number of these data points in detail, but first, in summary, 3 data points are pointing up or towards an expanding economy, and 8 data points are pointing down, or what you might call a recession, and 1 is flat. Both consumer confidence and consumer expectations are down. Business confidence is down. New housing under construction and new mortgage originations are down. But having said that, home prices are hanging in there and are holding positive, which is a good sign. And the Federal Reserve's leading economic indicator, which is called the GDPNow, is positive. GDPNow is an algebraic calculation comprised of almost a dozen data points, and it's just ticked up in the second quarter of 2026, and again, that's positive. But first, let's look at consumer confidence. If you're looking to buy or sell commercial real estate, or if you're looking to buy or sell a business, if you need help pricing those assets, go to our description box below this video and hit the more. You'll find 2 videos from our continuing education courses on how to both price commercial property and rental properties and how to price a business for either purchase or sale. I think you'll find these educational videos of help. Having said that, if you need help, feel free to reach out. There's no cost or obligation. As you can see, consumer confidence has been sliding down for the last couple of years, and is at about the same level as it was just before the 2008 Great Recession. Next, we'll look at consumer expectations. This chart surveys and summarizes how consumers feel about, their present economic situation, as well as how the consumer feels about the economy going forward. Now, as you can see, both have been sliding down for the last couple of years. It's a pretty safe bet that this is because of inflation. The consumer has lost between 30 to 40% of their purchasing power in just the last 5 years, and that's a lot. If you drop down to the description box below this video, you'll find 8 different essays categorizing the economy into different subjects. If you want to know more about inflation, take a look at the one titled Economic Summary. In that essay, you'll find charts on a dozen different consumer price indexes, all of them pointing out that inflation we've all experienced the last couple of years is still hanging around. For example, ground beef is up 76% just in the last 5 years. It's almost doubled in price. Next, we'll look at new housing under construction. This is new housing under construction. And it's been, really a good leading indicator or economic indicator for the last 60 years. And, as you can see, it has forecasted almost every recession over this time period. Now, having said that, by this indicator, we're in recession territory right now. Next, we'll take a look at new mortgage originations. New mortgage originations is showing, kind of mixed signals. On the one hand, it's in recession territory, but it has ticked up over the last 12 months, which is a good sign. Next, we'll look at changes in private inventories. Changes in private inventories is another really good leading economic indicator. As you can see, it's correlated almost directly with every recession we've had for 60 years. Let me explain this one because it may not be obvious at first glance. Back when I was in college, which, at this point feels like 1,000 years ago, I worked in the Oregon lumber mills. And when you saw finished lumber inventories start to build up outside, you knew sales were slowing down. And you knew at some point when inventories got high enough, they would just simply shut the mill down until those inventories burn off. In other words, when private inventories were heading down, you knew the market was bad and that the mill would be shut down. The point being, inventory levels and economic activity correlate pretty closely. When inventories slide down, you can almost bet the economy is sliding down too. Now, hopefully that makes some sense. This is taking a look at changes in private inventories, in a closer term. Over the last 6 to 8 months, inventory levels are burning off and are currently in the recession territory. Next, we'll look at the federal funds rate. There's probably no economic indicator more confused or convoluted than the federal funds rate. Interest theory postulates that if you lower interest rates, it will stimulate the economy. And if you raise interest rates, it'll slow the economy. It argues that interest rates and the economy are negatively correlated, and yet, in other words, they move in opposite directions. The empirical evidence, however, shows just the opposite. You can see this yourself. Just look at this chart. This is from the Federal Reserve out of St. Louis. And over the last 75 years, a drop in the federal funds rate either directly preceded a recession or was coincidental indicator of one. If you're a bit confused by this, let me try to reboot the thought process this way. Let's say the economy is strong and demand for money is high. Common sense argues that that leads to higher interest rates. If demand is weak and nobody wants to borrow, interest theoretically goes down. That being said, interest rates and the economy are positively correlated. Given a strong economy, the Fed raises interest rates, and given a weak economy, the Fed drops interest rates. Again, they're positively correlated. Let's look at where the federal funds rate is today. This is where we're at today. The federal funds rate is at 3.63%. Arguably, as you can see, the Fed has been dropping it for the last year. Next, let's look at where the Fed might be taking interest rates. This is the federal funds rate tracker. The next Fed meeting is on September 16th, next month, and the best minds out there think that there's a 43% chance that there will be no change. And 57% of the pros out there think that there will be a rate hike. And that's a big deal because it represents a change in direction. Rate hikes are generally argued from a position that's looking forward towards either a stronger economy or the Fed fears another round of inflation. My bet is that it's inflation that they're worried about. For example, the producer price index right now is up over 10% in the last 12 months. And that, without question, signals another round of inflation coming downstream at us. You might need to take a deep breath on that one. But last but not least, we'll take a look at GDPNow. GDPNow is, again, a construct of the Federal Reserve to try to get in front of GDP and forecast where the economy is going. GDP by itself is a really long and lagging indicator. It takes upwards of 12 to 18 months to even confirm you've been in a recession. The point being here is that GDPNow is forecasting a positive market moving forward. And arguably, that's positive. GDPNow has only been around since 2011, so it's not time tested. And personally, I'm not sure it works that well, but time will tell. So where does this leave us? Let's go back to the 30,000 foot level. So again, 3 data points are up and 8 are pointing down. The consumer is showing signs of stress and with expectations and confidence being negative. And at the same time, new housing under construction and changes in private inventories are both negative. I will argue overall that today's leading economic indicators are giving us a 70 to 80% probability of a recession or a declining economy. What I find interesting is that it's real estate, or the real estate market, that's showing positive signs. And it's real estate that is helping to hold the economy up right now. And as most of you know, going back to 2020, residential real estate prices jumped up 50 to 60%. And having said that, many people had been forecasting a correction in those real estate prices. But to date, that simply has not happened, at least not yet. But again, only time will tell. Until next month. Real estate brokers. How do you stay current with your clients who may not be buying or selling a property, for the next year or two? If you're not careful, they won't even remember your name a year from now. The question is, how do you stay relevant? I get it. I've been at this a long time, and it can be tough knowing what, if anything, to say when you call them, 6 months to a year from now. To solve that problem, I have for years kept in front of my clients by sending them an economic newsletter periodically. Today, we do that with simple 5 to 7 minute videos attached to an email. I've worked with some clients for well over 20 years, using the economy as a common denominator and point of communication. And I can tell you from personal experience, it works. In that process, if I can be of help, feel free to reach out to me. What I have found is if you do this, you'll come across as knowledgeable, experienced, and hopefully competent. And at the very least, they'll remember your name.